Global sentiment was negative during the fourth quarter, as concerns around the economic outlook took hold, giving rise to turbulent market conditions. This was despite the so-called trade war dialogue between the US and China signaling a 3-month truce. Optimism waned on worries around growth, while Fed policy talk, as well as the US government shutdown, also dampened spirits. In Europe, Brexit remained unresolved, and time is now seriously running out for resolution. Locally, improved data showed that South Africa emerged from recession and the Reserve Bank hiked rates. Growth assets such as equity and listed property sold off sharply during the fourth quarter, reflecting investor concerns around their prospects. Safe haven assets like bonds and gold, on the other hand, rallied. Global equities was the worst performing asset class this quarter, falling over 10% in rand terms, after having been the best performing asset class the previous quarter. SA equities, on the other hand, saw a more muted decline of 3.8%. Locally, only bonds and cash outperformed inflation for the quarter, reflecting a more difficult environment for equity-centric investments. Global conditions remain constructive for growth assets, but the environment may not be smooth sailing going forward. Global growth is still at a healthy level, but has decelerated, with global growth estimates being revised lower. Monetary policy, though still broadly accommodative, is tightening in developed markets, a trend being led by the Fed. Local economic conditions have not improved materially, with subdued growth still prevalent, but it's encouraging that South Africa has exited its recession in the third quarter. The economy grew 2.2% quarter-on-quarter in real terms in the third quarter, while the second quarter contraction was revised higher. While economic growth has been muted, inflation has gradually edged higher, prompting the Reserve Bank to hike rates for the first time since March 2016 in order to be ahead of the curve. During the fourth quarter, we trimmed some offshore equity but remain overweight. Rising macro risks, elevated valuations in the US at the time, as well as a material breakdown in price action, all led us to temper our enthusiasm for the asset class slightly. Importantly though, we remain constructive on equities overall in our house view, and positioning still reflects our preference for global over local equities. We do, however, acknowledge that South African equity has derated substantially, and valuations now are currently reasonably attractive. For more information on our current thinking, read the latest edition of Talking Points available on our website.